Hi, everyone. Welcome back to another episode of For What It's Worth with myself, Ben Hager, and we got Jeff Headley here. Jeff, we're off to a exciting start to the year. If I were to make one comment, I feel like last year we exhausted the word bubble.
Yes, we did.
Maybe this year we could exhaust the word uncertainty. Oh
Yeah,
no.
I think, we're 20 days into a new year and good Lord, yeah, we've had a lot of uncertainty and it just keeps growing, that's for sure. So
Yeah. Maybe kind of speak a little bit about what's going on this week in particular.
where do we want to start? Do we
Keep it
want to
brief.
start with Greenland?
Yeah. Yeah. So Davos is happening this week, right?
Yep, correct. And for those that don't know, Davos is the World Economic Forum where you have pretty much all the leaders of the world come together, discuss happenings in the world, what's going on economically, politically. And this is probably going to be one that is going to go down in the record books as being pretty interesting.
Yeah. So before we transition to our topic, we just wanted to touch on that real briefly. And it's interesting. I was on my way in today, and I was listening to some folks chat that are over there, kind of giving some feedback and kind of what's going on. And it was interesting. They said it feels like there's uncertainty on the uncertainty now. We're meeting to meeting, right?
Absolutely. And I think one of the interesting things is you and I have had these conversations and we've had them with clients that, if you could just let us be in an economic bubble, the
Hmm.
United States, and just leave everything else out, we probably have a really good year this year. The economy's doing well, the consumer's hanging in there, corporate earnings look good. We'll probably have some stability in interest rates. I mean, they could have some variations, but if you just kind of let that alone, we'd be okay. Unfortunately, we can't. And that's the policy uncertainty, I think, which is going to drive really this year.
Yeah, for sure, for sure. So with that being said, Jeff, let's get into our topic for today. And I think it kind of goes with the idea of uncertainty. It's a word that's been floating around out there, but it kind of feels uncertain. What is this? Why should I care? What could the impact be? So we're going to talk a little bit about stable coins. So Jeff, maybe a good place to start is just what are stable coins?
Well, and I do want to say that this conversation is going to be extremely high level. It's not going to get into the weeds. This is a very, very complex area, but it is something that is starting to grow in prominence and it's something we got to have a conversation about. And there's a lot of misunderstanding. And hopefully, what we can do in this conversation is just briefly kind of give an outline. Clearly, if someone wants to go deeper in it, they can reach out to us. But I do think that it's good for us just to have this topic. And to start with, a stable coin is a type of cryptocurrency that's designed to keep a stable value by being pegged to something predictable, usually like the US dollar or US Treasury. However, there are many stable coins that are backed by other cryptocurrencies, commodities such as gold, or even economic incentives and algorithms. So they can be pretty complex.
So it seems, I feel like the obvious statement there is it's really important to understand what you own, right? It's all over the
Very
board.
key, very
And I
key.
think it's important that you said this on the top, but I think that's where it's important to understand that really what we're talking about today is education of what this is and why we should at least understand it. This is not an investment discussion,
No,
right?
it's
This is
not.
an education discussion,
And
right?
and they are not money market funds or cash deposits, which we'll talk about.
Yeah. Well, so let's just go to the next question then. I think that's an important point. Why would someone want to use this then?
Lots of reasons, lots of reasons, but really it kind of comes down to four main reasons. And the first would be is that you want to make cross-border transactions cheaply, like international wires. I mean, international.
Businesses, right?
Yeah, absolutely. Or even individuals. I mean, if you're sending money abroad, it can be a cheaper way of doing it. Lots of times, people that are doing crypto trades, they want to park their money somewhere while they're doing those crypto trades. That's another reason. There are people that want to avoid having a bank hold their wealth. This is a place where they can do it. And in a lot of countries where you have a lot of instability, whether it's political, whether it's monetary, this is a great way for people to hedge against that, or capital preservation.
So all those make sense. right? I think there's a strong case to be made for all those reasons. If we were to look at this from an investment standpoint, though, do we make money? Do we get paid interest to hold these things like a money market that you referenced earlier?
The short answer is no. Holders do not automatically get paid interest. And this is what's very interesting. So if you looked at just buying a stable coin that was backed by the dollar, or even let's say a treasury, and the combined treasuries in the portfolio that was backing that stable coin paid 4%. You, as a holder of the stable coin, don't get that 4%. The issuer makes the 4%. So unlike a money market fund where you are paid the interest, or a cash deposit, you're paid the interest, you are not. It would be the bank would be getting all of that money. In certain circumstances, you can opt in to get paid something, but this involves additional risk and typically is done by the issuer lending out your stable coins to somebody else. In this case, you may get a part of the yield, but not the entire yield. Yeah,
All right. So we established this isn't a charity. They're making money.
right.
It's what businesses are for. You mentioned the word treasury in there. So it makes me think, are these things backed by the government in any way, shape, or form? Like we think of our bank deposits, right? And FDIC, anything like that.
No, they're not. They are only backed by the issuer and their underlying holdings. And this is where regulation becomes a big issue. So if you think about money market funds, obviously cash deposits, they are subject to bank-like supervision and regulations. There is very little difference between one money market fund or the other. We may be talking about 0.25% generally in terms of the interest you may be receiving. Unlike stable coins, that can take a large amount of risk, there are a lot of differences between stable coins. And this is where you have to really kind of hone into it, is that the only way you're going to get paid interest on a stable coin is if you increase your risk. And the issuers of the stable coins are rewarded for taking risk because their fees go up exponentially. And so that's very different than what you look at in a money market fund or a cash deposit.
Okay. So it kind of feels like the next natural question then here as we kind of talk through stable coins is how safe are these things?
Well, it's kind of interesting because you would think that by the term stable coin, that they would be safe, they would be stable. As you mentioned earlier, they are not FDIC insured. So first and foremost, now a money market fund isn't either, to be fair. But this question gets extremely complex. Again, the short answer is not as safe as a regular bank deposit. And let's kind of compare a standard money market fund to the safest stable coin, one that invests just in US dollars and T-bills, and kind of look at how they differ a little bit. First off, the money market funds, as we said, they're regulated. They maintain daily liquidity. Very rarely, once in 2008, do they go below $1 per share. So they're pegged at $1 a share every day, even though the underlying investments may go up. And they have access to Fed facilities to help stem some of that volatility. If you did have a run on them, it happens much more slowly. The Fed can offer liquidity that dampens fire sales, provides backstops. They also only trade during business hours, which is important. This allows policymakers to slow down a run. They can do things overnight. They can do things over a weekend. One of the other key things is you don't take on counterparty risk or issuer risk. This is some of the problems that we've seen already in the stable coins is issuer risk. In the event of a full-blown crisis, a money market fund can also rely on the government to be a lender of last resort. Again, that's one of the critical things. A stable coin, on the other hand, again, does not have regulatory authority to report to it. It is developing, to be fair. I mean, this is something that is happening right now. Their liquidity is fast and available 24/7, 365 days a year. It can be restricted. A issuer can restrict that liquidity. But because they trade continuously, if a problem does arise, it happens at internet speed and does not have a central bank to step in and slow the process. So there are no brakes that can actually slow down a run on a stable coin. So they also don't have one central government or bank to be the lender of last resort in a panic. And what makes this more complex is that stable coins can be traded internationally. So you could have geopolitical risk introduced as well that you would not have in the case of a money market fund, or a cash deposit. So while it's very rare for a money market fund to, as we said, break that buck, which would kind of start a run on it, we've had multiple instances already since 2022 where a stable coin has actually gone below that dollar peg. So the speed, the lack of regulation, the lack of government backdrops and backstops, those are things that really, quite frankly, I think people have to take into account when they're looking at stable coins.
So seems like a lot of risks, a lot of uncertainty,
Yep.
right? A lot of
Yep.
uncertainty, a lot being developed with this area. So why this is a big thing in the United States right now. We've heard some out of the current administration. Why would a government want this industry to be available?
Lots of reasons. I mean, there is the Genius Act, that was passed in the United States, which is really kind of around these stable coins. And, one of the problems that we have in this country is, we have to issue debt and we want to issue, or the government would like to issue that in a short term structure, not longer term. So they need to sell more short term debt. We're having foreign governments and buyers are slowly backing away. So they need to replace these buyers. A great example of that is just today an announcement, by a Danish pension fund that they're going to be liquidating some of their US treasuries. So you've got to have someone buy the debt. Stable coins is a great way to get that debt out there and get it sold. The other thing is it's a way for the US to strengthen the dollar dominance globally. If stable coins are adopted and used by more foreign entities, it comes back to their ability to be able to sell the treasuries, which really comes into buying the dollar. The other thing is we talk about crypto and lack of regulation. Well, if we become the primary issuer of stable coins, then that helps bring crypto dollars under US regulatory control. And, one of the other reasons that is mentioned is they want to shift the US Treasury funding away from the Federal Reserve and banks and not just have to rely on them. So
Mhm.
really it's about, quite frankly, getting debt sold and opening up new avenues for debt to be sold in the US.
Okay. So I think along the way here, we've touched on a few things where maybe we could connect the dots and say, okay, how could this potentially impact the families that we work with and their portfolios? Even if we never had anything to do with stable coins, there could be some overflow or some issues. So when we think about that, probably the biggest concern would be a major risk or issue due to stable coins that finds its way into our financial system. What do those broader risks potentially look like?
Well, from a lot of the reading that I've done on this, it really kind of comes down to how large the market gets. I mean, right now, this is a evolving market, but if this continues to grow, the risk goes up exponentially. And more importantly, the problem is that it can happen very fast. And under the current state, not having any government backdrops to stem a crisis, you start getting into exponential issues. And I think that the biggest risks that we can see, or at least at this point, really are to the treasury market via forced sales and the interest rate volatility that could create. Because again, if you have a run and it is a run on stable coins that are backed by treasuries, and all of a sudden you have this dumping of treasuries on the market, that is going to have an impact on driving up interest rates. And, when you look at that as just one risk, one of the other risks is because you're now getting into more of a international sales, or if this grows exponentially internationally, you could have a systemic risk, of a foreign crisis spilling back into the US, which would be tied to obviously the unloading of our treasuries again, which impact interest rates. And, these are things that you would not have happen with traditional cash deposits or money market funds. So I think the big thing here is the lack of regulation that we currently have on these. And I think more importantly is the incentive for the risk taking, because again, kind of going back to this, a traditional stable coin is not going to make a return for the depositor. It is a return for the issuer. And when you take that lack of regulation, the incentive for risk taking in the financial markets, we've seen the playbook. You don't have a lot of great outcomes, quite frankly, when that happens. And so that I think is where we start getting nervous when we look at this and say, okay, right now, probably the risk is very low. But if it continues to grow, that potential for risk just keeps going up exponentially.
Yeah, and I think it makes sense, and you could draw some correlations just because it's the kind of we're talking in a similar category. We could go back to the idea of cryptocurrency in its early infancy, little to no regulations. There was everybody had a hard idea wrapping their head around what is this thing even? Why would we ever use it? And it feels kind of similar today. But then you think about how large the cryptocurrency world has become since then, and regulations have kind of moved on up with that size and scale. So maybe it makes sense that very little regulation today. And I guess the hope and what we would be watching for to gain some comfort that this couldn't then turn into a much bigger risk is, does that regulation grow with the industry?
Yeah. And I think that whenever you're talking about financial markets, and this sounds really coy and maybe simplistic, it's okay until it's not.
Yeah.
And then when it's not, it is a real problem.
And that tends to happen really fast, right?
Very fast. And when you've got stuff like cryptocurrency or you have things like stable coins that again don't have breaks, and I can't emphasize enough that having a financial market close at the end of the day or having a weekend to breathe allows time for things to be fixed. It's hard to fix things when you're driving down the road at 100 miles per hour. And
Yeah.
and these are, I think, some of the things that just quite frankly exponentially adds to it. Regulations step in and regulations cut the amount of money that people can make. And so there's going to be a natural pushback, but we're going to have to come to some resolution here that there will have to be some regulation in order to, quite frankly, protect the financial markets.
Yeah, absolutely. Well, this has been an interesting discussion. Like I said, probably out of left field when you hopped on and maybe listened to us today, maybe not where you thought we were going to go with the discussion, but I think it's an important discussion. And
Absolutely.
Jeff, thanks for sharing all your thoughts here. Anything you want to wrap up on today?
Again, we scratched the surface. This is so complex. If you've got more questions, reach out to us. We can go through them. Obviously, like anything, we always want to make sure people are informed before they do something and read the fine print.
Yeah, absolutely. Great way to finish. All right. Well, thank you, everyone. That'll do it for this month. Look forward to chatting with you again in March.
Stay warm.
Take care.